Most people take denials personally, but it's important that people understand approvals aren't personal, they're structural. Banks are following a risk framework based on an algorithm, and it has no idea who you are. They're going to look at it purely from that numbers perspective, and it doesn't really matter what good habits you've recently started or what you're changing. Those are all great things, but the system is designed to look backwards instead of what might happen when we look forwards. By the end of this video, this will make sense. Banks aren't approving people directly, they're approving risk. And what that really comes down to is the predictability of repayment. Every metric comes back to, do we think this person is going to pay this loan back? As much as people think banks might want to love to foreclose on houses, that really isn't true. It costs a ton of money. What they're hoping for is that you successfully pay back that loan. One of the big pieces that goes into a credit decision is income stability. Stability is greater than spikes. So for example, that W-2 borrower who consistently gets paid that salary week in, week out, that person is going to look very stable versus someone maybe who has those big highs and lows in the world where commissions and incentives are paid. What they're looking for is verifiable, consistent income. For example, if you make about $120,000, but sometimes it's 80 and sometimes it's 140, and we're never really sure where that income's going to land, that's going to be different than that stable, say $75,000 or $80,000 a year from that salaried W-2 borrower. If income is unstable, the solution is to get to stable income. So for those people who are commission-based, it's getting that 2-year history or more of what your income looks like. For that business owner who might be doing a lot of write-offs, it's showing stable income and unfortunately paying the taxes that go along with that to make sure that that underwriter sees that stable income. Another big piece of it is something called the debt to income ratio, or DTI. This is where people get surprised. A lot of people think, well, I make so much, there's no reason you shouldn't approve me for this loan. But that's not really true. What they're looking at is the amount of money that you make versus the debts that you already have. So think your minimum payments on your credit cards, think your auto loan payments, your student loan payments, anything that has that fixed monthly payment that you're required to pay. DTI is the current monthly debts divided by your income, and that's what measures capacity for you to borrow more money. Someone with a 20% debt to income ratio is likely going to get approved for the loan that they're looking for. But someone who's up around 55% DTI, probably going to be another story. Likely a different conversation. But the important thing is that you understand what those measurements are. If you understand that measurement, you can then backtrack to what those current monthly debts are, figure what you may want to pay off or pay down to get yourself under that DTI ratio that's needed. The key is that we understand that it's measurable and it's adjustable. Once we know the rules and play the game, that's what's going to help get us to the correct destination. If this is helping you so far, please subscribe. We'd appreciate it. Next up, we'll talk about bank statements and behaviors. One of the things that we're looking for in lending is patterns, not perfection. So are we seeing that pattern of income coming in every 2 weeks or every 1st and the 15th, whatever your pay cadence may be? We're looking at overdraft frequency and seeing how you manage your accounts. Do you frequently have fees charged because you are overspending and overdrawing that account? We'll look for large unexplained deposits. Think about depositing cash that a family member gave you. Think about that money that you keep in a safe at home, suddenly depositing that. Things like that that are unexpected show us potential concern. Usually one mistake isn't an issue. A lot of the times we can talk about it, we can explain it, we can maybe provide paperwork that shows where that money came from. But if there's lots of unstable happenings occurring, what it really comes down to is your solution will be getting back to consistent, sort of normal pacing over time. After that, we're looking at credit structure and depth. So when you think of the credit score, that's obviously an important factor, right? There's certain limits. If you're under a certain credit score for a certain type of loan, you might be instantly declined. So the score is important. But it's important to know that it's just a summary. It's not the only thing that lenders are looking at. We're going to look inside the score. We're going to look at the length of your credit history. We're going to look at the mix of accounts. So for example, are these credit cards? Are they auto loans? Are they student loans? Have they successfully had a mortgage before? The other piece is this an account where you're actually an owner of the account, or are you just an authorized user? And an account owner is obviously better than just an authorized user. So that's something to consider as well. There's a big difference in history lengths as well. If we're looking at somebody who's only established credit for 6 months or maybe a year, that's likely going to be looked at a lot differently than that person who has a 12 or a 15 or a 20-year credit history. When we have that depth of credit age and that depth of structure over different types of lending, that helps reduce uncertainty and gives that underwriter a better picture of whether or not you're going to pay back the loan you're asking for. Other pieces include recent changes. So what we're looking for is stability over time. If you have a lot of inquiries in a short period, one, that's going to drop your credit score. So we certainly don't want to see a big points drop because of a lot of inquiries. It also makes lenders think, why is this person trying to get so much credit all at once? Is something going on in their life where maybe there's job loss or something medically related that's going to cost a lot of money? What is this person trying to get so much credit for? That will give an underwriter pause. Other things that we'll look at is general pattern breaks. So if you, for example, say that you are working a W-2 job and that you get paid biweekly, we're going to be looking for those deposits on your bank statements. So if that deposit suddenly isn't showing up anymore, that's going to lead us to wonder if you really still have that job, for example. So keep in mind, we really want to look for steady history without a lot of recent changes. One or two here or there, probably not a big deal. But if you're changing a lot fast, that's going to give a lender pause for concern. The last piece is looking at either automated or manual underwriting processes. So in the mortgage world, for example, we have Fannie Mae or Freddie Mac. So when you do a mortgage application, you might have yours run through either of those automated underwriting systems. A lot of companies have an automated underwriting process that they use, but there's also a manual underwriting process where someone's physically reviewing the documents. And in some cases, it'll actually be a combination of both, just depends on how a company is set up. So one of the keys is making sure that you provide paperwork, provide it quickly, be sure your paperwork's in order before you submit it, before you apply really, and make sure that whichever process you're going through is one that reduces uncertainty. The goal is the same in either version. We want to look towards approving a predictable risk, and the best way you can do that is by having the paperwork ready up front and making sure that everything is happening consistently within that paperwork. Now, if you were denied for a loan recently, keep in mind, it's not personal, it's structural. Just because it's a no right now doesn't mean it always will be. There's almost always a solution. So after you apply, if you do get denied, talk with the person who helps you with that application and see what their advice is. The vast majority of us have seen many applications, and we usually know what you would need to do to get things squared away for the next try. If that person doesn't know, perhaps you can ask one of their coworkers, maybe one of their managers to give you more information, or come ask me questions. I'll be more than happy to help you. You can ask questions in the comments, you can message me. I'd love helping people, so please know that there is a path forward. We just have to prepare strategically for you so that you're ready for that next application. If you liked what you heard here, please like, subscribe, comment, share. That all helps us grow. We really appreciate it, and have a great day.